Greetings traders, and welcome back. Thank you for joining me again. My name is Chris, and I will be your host today as we have another In-Depth with Chris episode. Today we're going to be discussing futures margin. We're going to talk about what futures margin is, as well as compare it to securities margin, and then we're going to outline all of the different types of margin out there, as well as how to calculate it. So it'll be pretty in-depth, so bear with me and let's have a good time together, because we always do. I'll see you on the other side. One of the most attractive features that the futures market offers is the fact that it allows trading with leverage. This just means that us as traders can commit to a relatively small amount of capital, but still have the ability to make large trades on an asset. The leverage is made possible thanks to what is known as futures margin. So that is exactly what we're going to be covering here today, futures margin. So what is futures margin? Well, it is simply the minimum amount of funds required in your trading account to initiate a buy or sell futures position. So in short, that means it is the minimum amount of capital that we need to execute one of our trades. The margin is usually based on a fraction of a contract's total value. The actual amount does vary from market to market, and it also will sometimes differ if the trader is doing a day trade or holding the position overnight, and we will get to that. But margin allows for trading with high leverage, which is actually a crucial instrument in the futures market. With leverage, we don't need to put up 100% of the futures contract's value, which can be quite expensive when we're initiating the trade. Instead, we can use our margin and enter a large position with a relatively small amount of money. Now, we want to keep in mind that leverage is always going to be considered a double-edged sword, because while the gains can be amplified, well, so can the losses. And sometimes the losses can be way heavier than our original margin amount should the trade swing the other way and the position not be closed. So let's just for a minute pretend that there's a guy right over here, and his name is going to be Mr. Futures, and this is his weapon. He's got really, really weirdly long arms and tiny legs. And then we have a guy over here, and this is going to be Mr. Securities Margin, and this is his weapon over here with, once again, really long arms and really small legs. So essentially what we've got going on here between the two of them, futures margin typically represents around 3 to 12% of the notional value of each futures contract, whereas securities margin generally requires the traders to put up somewhere around 50%, and it does change, but 50% in the face of the value of the security being traded. That's a huge difference. We're talking about 3 to 12% to 50%. In the stock market, margin refers to the money that we are required to have in our accounts in order to borrow against the asset. The amount that we borrow is kind of like a loan, which allows us to access greater sums of capital to buy and own stocks, bonds, and ETFs. The loan allows us to leverage our positions. This practice is also referred to as buying on margin, and it essentially amplifies our trading results to gain bigger profits on successful trades. In the futures market, however, margin is the amount of money that we are required to deposit and keep on hand with the broker when entering a futures position. Now, we want to keep in mind that it's not the same as a down payment. Funding our futures trading account with the required margin doesn't mean that we own the underlying commodity being traded. We can think of it like a good faith deposit, without which we won't be able to enter the trade in the first place. Let's take a moment to talk about the different types of futures margin. There are really two main categories. We have initial margin and then we have maintenance margin right here. First, we'll talk about the initial margin. The initial margin is just going to be the minimum amount of money that is set by a futures exchange platform to enter a futures position. It's really the exchange that will always specify the margin amount, but the broker is allowed to and will most likely have some type of additional deposit or requirement that we must add to our account before we can begin trading. That's very common as well. But we want to remember that initial margin is just a requirement by the exchange. The very minimum is going to be just the exchange requirement for us to open the position. Then we have our maintenance margin. The maintenance margin refers to the amount of money that we must maintain. So maintenance and maintain. We must maintain this amount of money in our account at any given time in order to cover any potential losses. So usually your maintenance margin is going to be lower than your initial margin, okay? That is almost always the case. And we actually have a graph here with a few different reports from the initial margin and maintenance margin as of recently that we can take a look at to see this type of behavior. So we have our initial margin column here, and then we have our maintenance margin column here. In the initial margin column, we can see that for the E-mini S&P 500, the initial margin is 13,200. With the maintenance margin, it's only 12,000, so it is a tad lower. Then with the micro E-mini S&P 500, once again, this is the micro E-mini, it's only 1320. So we just take a fraction of that and bring her on down. And then for the maintenance margin, same scenario, same ratio, down to 1,200. Crude oil is going to be 6,160 with a maintenance of 5,600. Gold is almost up there near those 10,000s, but 9,185 with a maintenance of 8,350. And then our 10-year Treasury note is 2,035 with a maintenance margin of 1,850. And that's just because, T-notes are crazy and all that good stuff, so they always have some arbitrary numbers. But moving on. So in addition to the initial margin and the maintenance margin, we also have what is usually referred to as day trade margin and overnight margin. With the day trade margin, this guy here, this is basically referring to the amount of money that we need for a full day's trade. This means that it will be the minimum amount of money required to day trade a contract. With day trade margin, we're basically opening and closing our futures position within the same trading session, and we're not carrying it forward to the next day's trading. This margin is almost always going to be set by our broker. As far as the overnight margin goes, this is also referred to as position trade margin on some platforms. So this is the margin that's required to hold our position past the closing time of the market and into the next trading day. This margin is also set by the exchange based on the futures contract, market, and volatility. So it depends on what we're looking at, but that will be set by the exchange. So we have the overnight margin, and that's going to allow us to hold our position through the closed off trading hours and wait on until the next opening trading day. Bum 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 tss, tss, tss. Bum 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 tss, tss, tss. That's my terrible attempt at making a scary noise because margin calls are every trader's worst fear. That's what happens when the phone rings and it's our broker saying we need to bring our account balance back up to our maintenance margin requirement. So what this means, in real people terms, is that if the funds that we have, if our account balance does drop below the maintenance margin that we agreed to maintain, they call us and say, hey, you got to bring it right back. And if we don't, they actually have the ability and will close our position out. Now, another option that we do have with a margin call scenario is we are also given the ability to reduce our position size in such a way that it does fall into the maintenance margin bracket criteria, whatever it is that we're trading. If we were to just take an easy example of, say we deposited 15,000. So we'll say we deposited 15K to an arbitrary broker, and we opened, say, 2 E-mini S&P 500 contracts. So we opened 2 contracts. Okay, so boom, open 2. And we're going to say that the initial margin required for that was 6,600 per contract. So that means 13,000. So that'd be 13.2K. So that'd be 13.2K as far as the initial margin that's required for 2 E-mini S&P 500 contracts. So we're within our right to do this. And let's say the maintenance margin was 6,000 per contract. So that means we would have a maintenance margin of 12,000. So we got a maintenance margin of 12K. So 12,000 is our maintenance margin. Well, let's say that the trade is, going all right, and then all of a sudden some bad market volatility just does not go in our favor, and we lose like $3,500. Well, what would $3,500 off of our, if we took that away, if we took 3.5K away from our 15, we're going to be below this guy here. We're going to be below the 12K. That means we are below our maintenance margin, which means guess what? This phone over here is going to ring, and the broker's going to say, hey, we need to go ahead and get your account back up to at least $12,000 for this position, or you have the ability to close off one of your E-mini S&P 500 contracts, because then your maintenance margin requirement would only be $6,000 because it'd be cutting it right in half. So long story short, a margin call is when we fall below our maintenance margin and we are required to do whatever it takes in order to make our account whole again with the maintenance margin requirement. So it doesn't matter how we get there, but we need to get there. And if we don't get there, the broker will close out our positions. So how are the futures margins calculated? The futures margins themselves are governed by the exchange through a calculation that is known as the Standard Portfolio Analysis of Risk, which from here on out, we're just going to call it SPAN. I'm not saying spam like that gross meat in a can, but SPAN. That is the SPAN margining system. So SPAN uses a complex algorithm to assess overall risk. It's done by calculating the worst possible loss that a portfolio might reasonably incur over a specified period of time, which is usually one trading day. It does this by computing the portfolio's potential gains and losses under different market conditions. An example would be, say, the CME itself. They do use the SPAN system to determine its futures margin. It utilizes the SPAN risk array methodology, which is a heck of a mouthful to say, to assign a set of numeric values, and those values indicate how particular futures contracts will realize profit or loss under various conditions known as risk scenarios. Each of those risk scenarios takes into consideration key factors, including changes in the underlying price of the index, current market volatility, and a decrease in time to the contract's expiration. The SPAN margin utilizes the value at risk, which is known sometimes as VAR, the VAR, value at risk, statistical concept to determine the initial margin. It's based on the premise that it should be adequate enough to cover losses incurred in a position in 99% of the cases based on historical data. Essentially, SPAN assesses risk involved with each contract. The greater the risk, the higher the initial margin requirement will be. Because the CME is one of the most popular organizations for futures contracts, many exchanges and other clearing organizations tend to use the CME SPAN parameters to compute their desired degree of risk coverage. And these are some of the ones, once again, that the CME is using, so it doesn't hurt to be familiar with them. The first one is called the price scan ranges, which is also referred to as the scan risk. This refers to the highest price movement that is likely to occur for each instrument under a specified time period. Then we have the volatility scan ranges. This is the highest level of change that is most likely to occur with the underlying volatility affecting each future options price. Next comes the intra-commodity spreading parameters. It sounds like something from the future. These are the rates and rules used to evaluate risks of closely related products among portfolios. Then we have the inter-commodity spreading parameters, which is the rates and rules used to evaluate risk offsets between related products. And finally, we have delivery risk parameters, which is the rates and rules used to evaluate the heightened risk of futures positions that involve physically deliverable products as the delivery period approaches. There are some benefits of futures margin trading that we should definitely mention. The first one is going to be hedge risk, and that's because it can help us avoid a buildup of losses. It helps us hedge risk because futures margin allows for sufficient liquidity in a highly leveraged market, since accounts must be topped up to continue holding a losing position. Then we also have that it can protect us from a total wipeout, which is somewhat similar to the hedge risk category. It can protect us from a total wipeout in a losing position, since the exchange and the broker will require us to top up our account whenever it reaches a certain level. And then a huge benefit is the fact that there's no counterparty risk. So this is key. This eliminates all counterparty risk with the process of the futures margin. With the futures margin system, all futures contracts have sufficient equity for settlement. So this in turn provides a safe and reliable futures trading environment for all parties involved. Naturally, there is drawbacks of futures margin, but not a whole lot. The prevailing drawback of the futures margin system is that the losses incurred on each contract must be settled on a daily basis. So sometimes the underlying index can enter bearish territory for days without any significant gain, but then make a sudden turnaround in one day and start posting some juicy profits. This means that the traders may have to hold on their positions throughout that period, which incurs additional equity injections for overnight margins. In conclusion, margin is one of those things that gets a bad rap, but not really deserving of it. People associate it with negative things just because of the margin call, which obviously no one likes a margin call. But in reality, the overall help of margin is something that generally is a net positive for us. In practice, it is holding the market together and actually preventing unnecessary losses on our own accounts, as well as an assurance that all parties will meet their obligations. And if you think that you were able to grasp all of these concepts and that your trading is there, make sure you check out the Gauntlet Mini, because I am seeing traders kill it, and I want to see if you have what it takes as well. But in the meantime, thank you for joining me again, everybody. Please click the like and subscribe button below so I can keep hanging out with you. But until next time, over and out. Happy trading!